Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
As far as direction goes, again, whatever you would use to play a sideways market, triangle, rectangle pattern type setup. Again, you know I like the MACD, so I might favor the move higher more so than the move lower. Or I could bracket this particular market cycle. As far as where I want to go ahead and start buying, as far as strike price goes, this is where I'll go back to the ISE, take a look at the website, see what my strike options are, get an idea of what I'd be paying for which. Here's where it gets very much custom. You know what your budget is. Everyone's got a budget. Okay, there's no magic number I'll tell you it's the perfect price to pay for an option. You want to pay for as little as possible. Okay, obviously. So, you're going to flip this thing, right? So you want to pay for as little as possible. So my advice to you is this. When you're doing that, you know what your budget is. Your budget might be different than mine. Okay? It probably will be. You might be willing to spend more than I will, or maybe you're willing to spend less. I don't know what that is. But what I'm telling you to do, what I'm advising you to do, is whatever that amount is, X, allocate that to time and to strike. So if you've got a little bit more to spend on an option, your budget allows you to spend more than the average bear, great. Spend it on time and strike. Don't pay for volatility. Buy during those quiet times. If you buy during the quiet time, you'll be able to benefit from what? The market moving in your direction, moving towards your strike with a lot of time left, okay? And I got to tell you, if the market here, this sideways market just kind of trickles out of this range, but trickles out, and this is the part of it we have no control over, okay? If the market trickles out of this range, obviously we're moving towards our strike, and then the option value will go up if we have a call. But this market has a big spiking day, has a day where there's a lot of movement very sharply higher in a very small amount of time, your volatility is going to go through the roof. It's a tension, right? So those are things we can't control. I can't control how prices are going to move, with or without a lot of volatility. I can control whether I'm going to pay for that volatility or not. Everyone starting to see where I'm coming from here? And by the way, when you start getting into other types of option strategies, understanding this being the foundation on which your future options trading might be built on, understanding this is going to make you so much better when you get into more complex positions, because you're going to get a good feel for the way these puts and calls move as correlated to the underlying market. Okay? And you're going to get a better idea of which one of these strategies to use depending upon the market cycle, whether the option strategy might be one that takes advantage of trending movement, whether it takes advantage of no movement. Your timing element for which strategy to use is going to be much, much better. Okay? So again, what we're doing in terms of how I do it is I'm always going to buy a put or I'm going to buy a call. Okay? I liquidate. I don't write premium. I'm not selling these things. I liquidate and I buy. If I'm buying a call, I'm expecting movement higher. If I buy a put, I'm expecting movement lower. Okay? I don't want to use the word sell. That insinuates selling premium, which I don't want to do. I personally don't do. You could eventually, but I recommend to everybody, trade like this for a little while, because if you can't trade like this for a little while, you're not going to be able to get the kind of feel for the way these things move in terms of what you want to pay and the value and how much they're capable of moving in terms of the volatility and how the premium will be affected and so forth. Okay? The value of the red, green, and blue again, that's my wave, and that is the 34-period exponential moving average. One set on the high, one set on the low, and one set on the close. Okay? So thank you for those questions. All right, so were there any pairs that any of you want to take a look at? Any pairs out there that you guys are interested in particular? I'd be happy to dissect them. Another pair I'm watching, by the way, is the dollar-yen right now. If you notice, the Dow is kind of getting range-bound. The Dow is range-bound. The dollar-yen is a great barometer of that. And what you'll be taking advantage of with the dollar-yen is the YUK symbol. Okay? So right now I've got a relatively sideways market cycle on the daily chart. It's transitioning into probably confusion on the daily dollar-yen. Again, the YUK. So I'm going to be looking for, well, in this case, I got to tell you, take a look. You see the same thing I do. We're looking at basically May of 2008 all the way to November of 2009. So it's over a year. I'm not sweating the fact that I've got more than I need. Don't worry about that. I'll expand this out here. I'm looking at, let's see, February of 2009 to October of 2009. So not quite a year, but the bottom line is you can tell what the market cycle is, right? Oops, sorry about that. You can tell what the market cycle is, right? It's moving sideways. When I've got that sideways market, I've got lower volatility. When I've got lower volatility, I've got a better advantage of the lower volatility pricing. Now, am I buying a put or call here? Well, it's going to be based upon whether I feel the market's going to, whether the Dow is going to move up higher or lower, whether the dollar is going to move up higher or lower. But I've got a pretty, not great, but I've got a pretty decent bottom here, don't I? I'm more likely to shop for puts. I'm sorry, let me say it again. I'm more likely not to shop for puts since I'm so close to a bottom. What I'd like to price are some calls. Now, of course, in any sideways market, I could bracket this, but when I'm so close to a bottom here, I'm much more interested in potential for call options. I'll be looking to buy call options, okay? All right, so let me take a look at some of these chats here. Just bear with me a moment. All right. So timing-wise, again, if it's an intraday chart, I want at least 2 to 3 weeks to expiration. And if it's a daily chart, I'm looking at about a month to expiration. So you got to take a look at the expiration dates. Okay? You got to take a look at the expiration dates back at the site. Take a look and see, how much time you have. So if it was an intraday chart, today's the 10th. Well, this November 21st is going to be borderline for a 240-minute chart. It's a no-go for a daily. I'm going to have to push out to a December 19th for a daily chart setup. Okay? It's borderline for the 240. It's probably better off for both the 240 and the daily if I go with that at least the December 19th. I might even push out into January, depending on how long I think it's going to take. Now, by the way, do I expect a lot of market movement through December? Well, that's the big question mark. If I get a Santa Claus rally on the Dow, it's going to affect the dollar-yen. And I could get a pretty dramatic move here in the next 6 weeks, 6 to 8 weeks, right? If I think the market's going to go to sleepy time towards the end of the year, that's one of the unique factors of the end of the year. A lot of the options I'm buying now, believe it or not, I'm looking out for Jan or March expiration because I realize that I could very well get those big moves in the Dow and the dollar at the end of the year, or I could get nothing. So that's one of the unique situations I'm in here at the end of 2009, and I'm actually looking out towards January and March for my expiration. I'm giving them a little bit more time because of the time of year we're rolling into. Okay? Let's see. As far as why the 3 lines, yes. Support and resistance doesn't exist, I think, as a line in the sand. I don't think support and resistance turns on a dime. I think it's a cushion, and that's why I use all 3 lines. So yes, absolutely. In the case of a downtrend, the resistance starts at the red and extends all the way to the green. In the case of an uptrend, the support starts at the green and extends all the way down to the red. So yes, absolutely.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.